Investing vs. trading, what's the difference? Trading and investing are two different ways of trying to make money in trading and investing in finance marketplaces. Both traders and investors want gains through market participation. Over the long run, both want higher returns over a longer time frame by buying and holding. However, traders profit from both market conditions, both rising and falling, to make moves to exit and enter positions within a short time frame and earn smaller, less frequent returns. The investment process is a long-term one to the market and typically can be used to fund such things as retirement funds. Strategies for trading involve short-term strategies that maximize profits daily or monthly. Investors are more likely to take through short-term losses, whereas traders are more likely to try making deals that will allow them to make money quickly from fluctuations in markets. Making an investment. In the long run, we are investing to slowly increase wealth over a long period by purchasing and keeping an investment portfolio comprising stocks, stock baskets, mutual funds, bonds, and various other investment options. Investments are typically held for an extended period or even for decades, taking advantage of benefits like dividends, interest, and splits in stocks along the way. Although markets are bound to fluctuate, investors ride out the downtrends in the belief that prices will recover and losses will eventually be recouped. Investors are typically more concerned about fundamentals in the market like price-to-earnings ratios and forecasts for management. Anyone with a 401k or IRA is investing even if they're not regularly monitoring what happens to their portfolios, as the objective is to increase the size of an account for retirement over time and years. The fluctuations in the day-to-day performance of various mutual funds are not as important as steady growth over a long time. Trading. Trading involves more frequently occurring transactions that include purchasing and selling commodities, stocks, currency pairs, or other instruments. The aim is to earn yields that are higher than buy and hold investment. While investors might be satisfied by the annual output of between 10% and 15%, investors could want to earn 10% every month. Profits from trading are earned through buying at a lower price and selling for a higher price within a very short period of time. Also, the reverse is the case. Profits from trading are made when selling at a more expensive cost and purchasing to cover the cost at a lower cost, known in the context of selling short, to earn a profit when markets are in decline. As buy and hold investors hold more profitable options, traders are looking to make profits within a predetermined amount of time. They typically use the protection of a stop-loss order to shut down losing positions at a specified price. Trading professionals often use analytical tools for technical analysis like stochastic oscillators and moving averages to identify high-risk trading strategies. The term style refers to the duration or period of holding that commodities, stocks, and other trading instruments are purchased and traded. Traders typically fall under one of four groups. Position trader positions are held for the months up to. Swing trader positions are held for several days. Day trader positions are kept during the day, except overnight trades. Scalp trader positions are kept for seconds up to minutes without nighttime positions. Traders typically select their trading style depending on factors such as account size, the amount of time committed to trading, degree of experience in trading, personality, and risk tolerance. Thanks for watching.